CBA's internal credit and debit spending data showing slowing consumer discretionary spending. Joining us now is Yu Lee from Blackmore Capital to speak about portfolio positioning in a defensive market. You, terrific to catch up with you. Thanks so much for joining us here on AusBiz. Good to have you with us. All right, so let's we're going to also talk commodities in this space at the moment, but I just started out there talking about consumer discretionary. Of course, that is a sector that is expected to fall significantly as the economy winds down, but also obviously as those interest rates rise. How are you seeing that sector? Are you avoiding it, or are you seeing any value there?
Yeah, good morning, Andrew, and thanks so much for having me on the program. Nice to chat with you. So yeah, absolutely. Like you pointed out, the data that we have seen particularly came out from CBA's internal credit and debit spending data. We see that there is moderating in terms of consumers start to spending a bit less on that discretionary space. And particularly what we see is that peak in spending seems to have happened just around May, which is right before sort of the RBA started for the rate rise. So obviously there would be concern. Consumers are actually responding to the higher living cost pressure and higher interest rate. But at the same time, what we also see is that maybe a less sensitive area to look at is the staples. So the staples, if we think about sort of the correlations between the supermarket sales and the actual inflation, we do see that more positive rather than negative correlation. So what we'll be closely looking at during the reporting season right now is that to think about how companies actually managing that, how companies managing the top line growth, but at the same time, the cost management, the product mix management to obviously manage that margin.
So are you liking those staples at the moment, the likes of Woolworths, Coles, Metcash, or are you waiting for those earnings results before you take a position?
Yeah, we definitely like those stocks, and the portfolio is quite defensively positioned at the moment, and our exposure is in the stocks that you've mentioned, like Woolworths and Coles, the household names. But there are things that we'll be paying specific attention to during the reporting season. For example, the inventory levels that companies looking at, and also just the confidence that those companies will be able to provide guidance and the earnings visibility in terms of how the company is actually seeing the trend continue.
So just as far as the discretionary stocks are concerned then, the likes of Harvey Norman, Nick Scali, and I guess also some of those e-commerce players such as Temple & Webster and Kogan, are you seeing any value there, or are you just very wary about where the economy is going at the moment and how consumers are likely to respond to this?
Yeah, we think the market is probably playing more on the micro environment than fundamentals. So what we are taking the position now is really a bit more defensive and wanting to take a hold on the discretionary.
All right. Well, let's switch to commodities. Of course, we have seen some fairly steep falls in recent times, given they're cyclical. So let's get your opinion of how you're looking at the broader materials market, I guess, and whether you're seeing any value there.
Yeah, so with the commodities, actually what we really like right now is copper. But as you can see, that being the metal that is quite geared to the economic recovery and the economic activity, what you have seen is that copper price react to sort of the consumer or react to the economy prospects quite a lot. But at the same time, although we see that copper price kind of falling year to date, what we have is this very structural investment thesis that we think is going to play out over the medium term, particularly with that fundamental being shaped by the risks that we see from the production side, particularly coming out of Chile. As a matter of fact, I saw some numbers this morning coming out that the first half of production come out of Chile actually has down 6.1% for the first half of 2022. This number, if you put it into context, it compares with the April forecast that the Chile Copper Commission actually had, which is supposed to be a nearly 3% increase. So the production risk that we're seeing there with the inevitable growing demand is what we think is going to continue to drive the drawdown of that inventory, and the difference between that supply and demand continue to play out, and then really are standing on that thesis on the structural fundamental change.
So on the demand side, though, you're playing for the longer term then, clearly, because we have seen demand come off, and I guess you take a look at copper, Dr. Copper, seen as the barometer of the global economy as it starts to slow down. However, are you more focused on, I guess, the electrification of the planet and that demand, that strong demand for copper in that space?
Yeah, exactly to your point. I guess longer term, not only to sort of the copper fundamental that we are looking at, which underpins the investment thesis, but also this is really underpins the investment decisions that we make in positioning our portfolio as well. And you mentioned electrification. So what we are seeing that over the longer term, you do see that green transition or energy transition is going to be a theme that played in that copper demand, regardless of what the, I guess the market is looking at in terms of fear of recession that's actually driving the short-term price. So with copper, the metal trading more on the micro environment and leaving what we see, the fundamental, the cost curve, the inventory analysis sort of be more irrelevant in terms of the short-term price indicator. But what we really see is that over the long term, copper, the role it plays in green transition, there's a reason why we call copper the metal of electrification, right? Because the essential role that it has in all those electrical technology, which is a big theme that we are seeing as well.
So you specifically, which companies you've got exposure in at the moment in that space?
Right, so in the portfolio right now, Oz Mineral is our copper play. As you correctly point out about the price sort of movements, when we are actually looking for the miners or looking for the exposure in those assets, we really want to looking for producers that has tier 1 assets, that they produce in sort of really reliable jurisdiction, but they also have low cost profile as well. And what that means is that it would provide them great leverage when they are in that pricing environment that's just not as high. So Oz Mineral is a play that we have in the portfolio. It has this really realistic suite of assets that we like. So basically, it has these 2 long life underground copper and gold mine in South Australia, but also at the same time a greenfield development option in Western Australia, and it has exactly that cost advantage that we were talking about. So if you think about the all-in sustaining cost, which is really the cost for Oz Mineral to actually produce copper, it is sort of locating at what you call the 25th percentile when it compares with the global peers. So that advantage is going to make sure that it would have the ability to continue to generate cash flow.